Want to start making sequential offers over a period of a few weeks so that we can lock in the deal at the best possible terms for us. Hey guys, Carl Allen, welcome to day number 7. We're almost there on 10 days to doing your first deal. So yesterday, day 6, we got into the whole concept of valuation and structure. And today in day 7, I'm going to show you how you can structure your offers, because what we don't want to do is we don't want to go in on a deal with our highest offer. We want to start a little bit lower, not too crazy low, because we don't want to upset the business owner and break rapport, but we want to start making sequential offers over a period of a few weeks so that we can lock in the deal at the best possible terms for us. So I've actually got a really awesome, cool piece of content that I've snipped out from one of my online masterminds, and I'm going to be showing you this now. Enjoy that. It's about 10 minutes, and then I will see you at the end for a recap.
But say, for example, that you've got a business that you're looking at where it's a broker deal and the seller has got really inflated value expectations. Then offer 1 may very well get countered. So you put in offer 2 and so on. And as you incrementally make these offers every 3 to 4 days, we keep the seller sweating. It makes the seller really think that you're returning to your numbers and rerunning your models, and you're talking to your financial partners and all those different things. So eventually you'll see the movement from the seller, even with a seller that has a really inflated value expectation. But if you've been leveraging the deal-making triad properly and you've got that highly motivated or distressed seller of a good business, you'll see the movement happen a lot quicker. And it might be that offer 1 or 2 or 3 gets accepted rather than offers 4, 5, and 6. But I'll show you in a minute how by having much more inflated offers actually doesn't cost you A, any more money, and B, affect the cover ratio. That most important ratio, that greater than 1.5 ratio in the green box, that auto-calculated in the valuation. So just to summarize, these were the outputs from the modeling that we did in our example deal in module 5. So here's an output for the EV method using the multiple of EBITDA, and also the balance sheet method where we're taking the net asset value of the business plus that goodwill that we calculated. So the valuation range for 100% of the equity was kind of in the $1.9 million to $2.7 million range. And stripping that back down to enterprise value, just to value the business, was $1.6 million to $1.9 million. So for the offer sequence, we now go and prepare 6 offers. So the first one is based on the summary that you had before. And all I do is I make the first offer just with 75% of the calculated closing payment. Offer 2 will be 100% of the calculated closing payment. And then for subsequent offers, I can sweeten the deal in 4 different ways. So offer number 3 will be to just add 1 additional year to the seller financing. It doesn't change the cover ratio or the financing, it just means you're paying for the business for 1 extra year. And if you're scaling the business and you're leveraging all those cross-selling opportunities and all those deal synergies, you could be able to do that much faster. Offer number 4 is where I introduce something called an earnout, which I'll talk you through in a minute. Offer number 5 is you leave the seller with, say, 10% of the equity. So you only buy 90% of their business and leave them with either 10%. And then offer number 6 is where you sell some equity to an investor to raise more capital, which means you can make a higher closing payment. But again, you won't own 100% of the business. You're going to have a minority investor in there. Whilst it's a bad thing to get too diluted, if that investor that partners with you can add massive value to the continued growth of your business, then it's not such a bad thing. So let's go through the example. So again, our original valuation was between 1.7 and $1.9 million with a closing payment of $844,800. So offer 1 will be to reduce that by 25% to $633,600. Now, the $830,000 of seller financing, that stays the same. The debt that we're inheriting is the same. There's no earnout, there's no retained equity, and there's no selling equity to anybody else like an investor. So we're offering about $1.85 million for that business, and our payment cover is 1.8. Now, if that offer gets rejected or it gets countered, then you already have offer number 2 ready to roll. But wait 3 to 4 days, then make offer 2, which is offering the full closing payment, the seller financing, and the debt. So offer number 2 would be 2.07 million, a little above the top of the range. That's an increase of about 11.4% or $211,000 on your opening offer. Again, the cover ratio doesn't change. Now, that offer might get accepted, or you might get another counter offer, in which case we go to offer number 3 if we need to. So again, it's the exact same closing payment, but this time we're going to add an extra year of seller financing. So the seller financing for this deal goes from $830,000 up to just over 1.1 million by adding that extra year. The annual payment stays the same. The debt inherited stays the same. We're just adding a 4th year. Earnouts, retained equity, selling equity, we haven't done that yet. So now we're offering $2.3 million and change for this business. And the payment cover is still 1.8. And it's a total payout increase of nearly $490,000. We've actually increased our original offer now by 26%. So it's starting to get really, really interesting. It's still a safe deal. We've still got a payment cover of 1.8, and we're not raising any more money. So if necessary, if you really like the business and the seller's really negotiating hard with you, then if you need to, you can move to offer 4, which is the same closing payment, the same 4 years of seller financing, the same debt that you're inheriting. But what we do now is introduce something called an earnout. Now, an earnout is where you're giving the seller bonus payments for increased future performance of the business. So a seller might say, look, I want $2.7 million for this business because I've got all of these contracts that I've just won and they're all going to be paying off in the next couple of years. It's going to be a lot more revenue, a lot more cash flow that you're going to see washing through this business. So, I want a little piece of that. So you can isolate them and then you can pay the earnout when that incremental profit is realized. I do a whole lesson on earnouts in a lot more detail in module number 7, financing. But think of an earnout as a kind of bonus payment to the seller above the current levels of profitability. So it's only going to be a win-win situation. So let's say we offer a $400,000 earnout as part of this deal, or $100,000 per year on our 4-year payment structure. So that takes the total deal value to just over 2.7 million. That's maybe what the seller wants. So now this is $888,000 above your opening offer. It's a 47.9% increase. So you're really going over the top to buy this business if you need to, but it's not costing you any more money and your payment cover remains the same. And normally, when I get to offer 4, if that's declined, I just move on to a different deal. But in some cases, if this business is going to generate so much economic value add for your net worth and the value of your existing business, then there are 2 other steps. But just be mindful of deal heat and make sure you've got lots of deals in your funnel. But if you really want to go to town on a deal, the next step is you can let the seller retain 10% of the equity. So again, if offer number 4, our total deal value was about 2.74 million. If you would turn to offer 5 and said, okay, Mr. Seller, I'm only going to buy 90%. I'm only going to leave you with 10% of the business. Then technically, you're adding another $274,000 to the valuation because you're letting the seller keep that little piece of equity. So now that takes your offer over a $3 million valuation, but your payment cover It's still 1.8, as you know, and we've increased our offer now by over $1.1 million, or 62.6% for an offer number one. And then if you absolutely, really need to, offer number 6 will be offer 5, plus you can then go and sell a 10% equity stake to an outside investor. Again, $274,000. And if this business is absolutely mission critical to you, you've got no other deals on the table, and this deal is going to drive massive amounts of EVA and wealth creation for you, then you might well consider diluting your equity. It's better to own 80% or 90% of something than 100% of nothing. So offer 6 is now $3.3 million almost. The cover ratio, the payment cover is the same. It's 1.8. That's not changing. But now we're offering more than $1.4 million, or 77.4% more than in offer number 1. And it's not costing us any more money. We've extended seller financing by a year. We've added an earn-out bonus. We've let the seller keep 10% of the business. And we've sold another 10% of the business to someone else, which means that we can buy it because we get that extra capital we can pay at closing. So that's it for lesson number 1. I'll see you next on lesson number 2, where we'll go through how to submit your offers, and I will see you then. Until then, bye for now.
So I hope you enjoyed that and you understood the sequencing part by starting at a lower valuation and then building up. And what we're doing inside of that sequencing is we're not affecting the debt service cover ratio at all on the deal, which you know has to be a minimum of 1.5. So for every $150,000 of cash flow that the business generates from its trading, we only want to be spending a maximum of $100,000 a year in servicing the deal, in paying for the deal, no matter who's financing, whether it's seller financing, whether it's bank financing, SBA, it doesn't matter. And by starting lower at that point where we're not going to break rapport, but we can then start to build up from that and then put those offers in every few days after that. We'll always be 3 or 4 steps ahead of the seller. They won't know what's hit them. It's going to be amazing. You've got all this kind of figured out. And you saw how creative we can be in sweetening the offer without impacting that debt service cover ratio. We can extend seller financing. We can leave retained equity in the business for the seller. We can sell equity to somebody else and have a partner, preferably a partner that can add a lot of value to the business. So really cool. That was day 7. Tomorrow, day 8, we're going to get into the deal execution phase. So I'll teach you all about the legal process. I'll teach you about due diligence. We'll talk about LOIs. We'll talk about financing protocols, all those different things, because by now you should have shook hands on the deal, and it's now all about getting that deal to closing, which we'll cover in day 9. And then day 10, I'm going to tell you about how to grow the business, which, as you know, is where you make the most money as being a deal maker. So hope you enjoyed day 7. I will see you tomorrow for day 8. Until then, bye for now.
Hey guys, I'm Carl Allen. I'm the founder of Dealmaker Wealth Society. I've done tens of billions of dollars of deals over the last 30 plus years. If you're new to my channel, definitely hit like and subscribe so that you can get all of my amazing Dealmaker content in real time. You're not going to miss any of the outstanding information that I'm going to share with you. And if there's a question that you've got, if there's something that you want to know the answer for and you want me to speak to it, definitely hit me up in the comments section and I will record those videos for you and I will get them on this channel as soon as possible. So love having you part of this YouTube community and I can't wait to serve you. Until then, bye-bye for now.